Folks, I'm going to tell you something that might make you uncomfortable, but I've been doing this for 75 years, and if there's one thing I've learned, it's that the truth doesn't care about your feelings. Right now, as I sit here talking to you, we are staring down the barrel of a crash unlike anything most of you have ever seen. Not since 2008, not since 2000. This one's going to be different. And the people who aren't prepared or are prepared are going to get absolutely demolished. Now, I know what you're thinking. Warren, you're 94 years old. You've been predicting crashes your whole life. That's not true. I've been warning about aspecific conditions my whole life. And right now, every single alarm bell that served me for 7 decades is ringing so loud I can barely hear myself think. Let me give you the numbers that are keeping me up at night. The S&P 500 is trading at a Shiller PE ratio of about 32. That's twice the historical average. The only times we've been higher were 1929, 2000, and 2021. You know what happened after each of those. I think you do. The Buffett indicator, the total market cap to GDP ratio that people named after me, it's sitting at 95%. Anything above 120% is considered overvalued. We're in the nosebleed section of nosebleed territory. Margin debt, the money people are borrowing to buy stocks, is near all-time highs. Corporate debt to GDP is at 47%, matching the peak we saw right before COVID hit. And here's the kicker. Berkshire Hathaway is sitting on $334 billion in cash and short-term treasuries. That's not because I can't find anything to do with it. It's because I refuse to play the fool in a rigged casino. But Warren stocks always go up in the long run, right? Sure they do, in the long run. But the long run is made up of short runs. And in the short run, we're about to drive off a cliff. Let me tell you a story. In 1968, I closed my investment partnership. The market was soaring. Everyone thought I'd lost my mind. Why would I walk away from free money? Because I knew what was coming. By 1974, the market had crashed 48%. That's what happens when you pay $3 for something worth $1. Eventually, reality shows up and sends you the bill. We're in that same situation today, except it's worse, much worse. Because this time, everybody thinks they're a genius. The retail investor mania we're seeing in 2025 makes the 1990s look like a Sunday school picnic. People are day trading on their phones during lunch breaks. They're putting their rent money into options. They're taking advice from teenagers on TikTok who've never lived through a bear market. You know what I call that? I call that kindling. And the match is about to be lit. Let me walk you through exactly how this crash is going to unfold. Because unlike the talking heads on CNBC who just want you to keep watching, I'm going to tell you the truth. And the truth is ugly. It won't start with a bang. It never does. It'll start with something small. Maybe a major company misses earnings by a penny. Maybe a regional bank fails. Maybe commercial real estate defaults tick up. It doesn't matter what the trigger is. What matters is that the market is so overvalued, so over-leveraged, so overhyped that anything can be the pin that pops the bubble. Here's what I'm watching specifically. The magnificent 7 stocks, Apple, Microsoft, Google, Amazon, Meta, Tesla, and NVIDIA. They represent about 30% of the S&P 500's total value. Think about that. 7 companies are holding up the entire market. That's not diversification. That's a house of cards. These companies are trading at an average PE of 35 to 40. That's expensive even for great businesses. And they are great businesses. I own Apple. But at some point, price matters. At some point, you're paying so much for future growth that even a small disappointment becomes catastrophic. Tesla is the poster child for this insanity. Great company, brilliant CEO. But it's trading at 60 times earnings for an auto manufacturer in a brutally competitive industry with declining margins. When reality sets in, that stock doesn't go down 20%, it goes down 60%. And when Tesla drops 60%, the retail investors who piled in thinking they were geniuses, they panic. They sell everything. And the contagions, the other thing I'm watching is the Fed. Right now, interest rates are around 4%. That's not historically high, but it's high enough that companies with floating rate debt are starting to feel the squeeze. High enough that refinancing is becoming a nightmare. High enough that consumers are maxing out credit cards at 24% APR just to maintain their lifestyle. Here's the dirty secret nobody's talking about. When rates were at zero, everything worked. Zombie companies could borrow forever. Unprofitable tech startups could raise endless venture capital. People could buy houses they couldn't afford. But at 4%, that whole game falls apart. And if the Fed has to raise rates even higher to fight inflation, or if they simply keep them here longer than expected, watch out below. Once the selling starts, it feeds on itself. First, the algorithms kick in. High-frequency trading systems that have been programmed to, by the dip, suddenly switch to selling the rip. They don't care about fundamentals. They just follow momentum. And when momentum turns negative, they accelerate the decline. Then come the leveraged investors. Hedge funds that borrowed 3-to-1 to juice their returns. Private equity firms that loaded companies with debt. Retail investors who bought stocks on margin thinking they'd found a cheat code. These people don't have a choice. When prices drop and margin calls come, they have to sell. Doesn't matter if it's a good price or a bad price. They have to raise cash immediately. This is when the real carnage begins. ETFs start getting hit with redemptions. Passive index funds that bought everything on the way up have to sell everything on the way down. There's no human making thoughtful decisions. It's just mechanical selling, billions of dollars every single day, pushing prices lower and lower. And here's the part that's going to shock people. The stocks that went up the most will fall the hardest. All those AI stocks that tripled in 2024, they're going to give it all back and then some. Those meme stocks that retail traders pump to absurd valuations are going to go to zero. That can't lose portfolio your buddy bragged about. It's going to be cut in half. I've seen this movie before. In 2000, Cisco was trading at $80 a share, 200 times earnings. Everyone said it was the backbone of the internet, that it couldn't fail. 2 years later, it was at 10, a 90% decline. It took 15 years just to get back to the 27. People who bought at the top in 2000 still haven't broken even, and it's 2025. That's what happens when you overpay even for a good business. This is when Main Street finally realizes what's happening. Up until now, it's been mostly institutional investors and traders taking losses. But when 4L wonk, statements arrive showing 30% declines. When home prices start falling, when layoffs start mounting, that's when the average person panics. And the average person doesn't sell intelligently. They don't say, well, stocks are cheaper now, so I should buy more. They say, I'm losing everything. I need to get out before it goes to zero. They sell at the worst possible time, locking in maximum losses. This is when you'll see capitulation. The final purge. Volume will spike to levels we haven't seen since 2008. Volatility will go through the roof. The VIX could hit 50, 60, maybe even 80. At that point, nobody's thinking about fundamentals. Nobody's calculating PE ratios. Everyone's just trying to survive. And this is when the real opportunities emerge. But you have to have cash to take advantage. You have to be Warren Buffett sitting on $334 billion, waiting patiently for the sale of the century. If you're fully invested right now, if you're leveraged, if you're in meme stocks or crypto or other speculative garbage, you're not going to have any cash when the opportunities arrive. You're going to be too busy trying to stop the bleeding. Let me tell you how bad this could get. The S&P 500 is around 6,000 today. In a mild correction, we see 5,000. That's a 17% decline. Been there, done that. In a moderate bear market, we see 200. That's a 30% decline. Painful but survivable. But in a full-blown crash, driven by margin calls, forced selling, and panic, we could see 500 or lower. That's a 40% decline. That would wipe out $15 trillion in wealth. Trillions from 401ks, IRAs, pension funds, and individual portfolios just gone. And the really scary part, some stocks will fall much more than 40%. The speculative stuff, the unprofitable companies, the overvalued tech darlings, they could easily drop 60%, 70%, 80% or more. Now, some of you are thinking the Fed will step in, the government will bail us out. They won't let it get that bad. And you know what? You might be right. But ask yourself this. Should your investment strategy depend on a government bailout? Should you be betting your family's financial future on the Fed riding to the rescue? I've never invested that way. I've always assumed I'm on my own, and that discipline has served me pretty well. What's causing this? The perfect storm. Let me break down the fundamental problems that are setting up this crash. First, valuations are insane. We've already covered the Shiller PE of 32 and the Buffett indicator at 995%. But let me put this in perspective. The long-term average PE for the S&P 500 is about 16. We're at twice that. That means either earnings need to double, or prices need to get cut in half, or some combination of the two. I know which one is more likely. Second, corporate earnings are peaking. Companies spent the last 2 years cutting costs, laying off workers, and squeezing margins. There's not much left to squeeze. Revenue growth is slowing. Margins are compressing, and yet analysts are still projecting 12% earnings growth for 2026. That's delusional. When the reality of 3% to 5% growth hits, or worse, when we see actual earnings declines, multiples are going to contract violently. Third, consumer spending is tapped out. Credit card debt is at all-time high. Savings rates are near all-time lows. Pandemic stimulus is long gone. Student loan payments are back. People are barely hanging on. And when the stock market crashes and the wealth effect reverses, consumer spending is going to crater. That's going to hit corporate earnings even harder, creating a vicious cycle. Fourth, commercial real estate is a ticking time bomb. Office buildings are half empty because of remote work. Malls are dying because of Amazon. Apartment buildings are over-leveraged because of years of cheap money. When these loans start defaulting, and they will, it's going to ripple through the banking system. We've already seen a preview with the regional bank failures in 2023. That was just the appetizer. The main course is coming. Fifth, geopolitical risks are everywhere. We've got tensions with China. We've got wars in multiple regions. We've got an election year with extreme polarization. Any one of these could be the spark. And in an overvalued market, sparks cause explosions. Before I tell you what to do, let me tell you what not to do, because this is where most people screw up. Do not panic sell everything. Yes, a crash is coming, but trying to time the exact top is a fool's errand. If you sell now and the market goes up another 10% first, you'll feel stupid and probably buy back in at the wrong time. Do not buy the dip too early. I guarantee you when the market drops 10%, every talking head on television is going to say it's a buying opportunity. They're going to trot out charts showing how every dip in history was a great time to buy. Ignore them. In a real crash, there are multiple dips. The first dip is a trap. The second dip is a trap. Even the third dip might be a trap. You want to wait until you see true capitulation, until stocks are genuinely cheap, until fear's at a maximum. Do not go all in on gold or crypto. I covered gold extensively in another discussion. It's not the answer. And crypto, don't even get me started. When stocks crash, crypto crashes harder. It's not a safe haven. It's a speculative asset that will get obliterated when people need real cash. Do not invest in things you don't understand. When the crash comes, there will be all sorts of opportunities pitched to you. Special SPACs, distressed debt funds, complex derivatives. If you don't fully understand it, stay away. The worst losses happen when sophisticated predators sell complex garbage to unsophisticated prey. All right. Enough doom and gloom. Let me tell you how to not just survive this crash, but position yourself to thrive on the other side. First, raise cash. Not all of it, but more than you have now. If you're 100% in stocks, that's too much. Start trimming positions, especially the ones that have run up the most, especially the speculative stuff, especially anything you wouldn't be comfortable holding through a 50% decline. My rule of thumb is, if you wouldn't buy it today at current prices, you probably shouldn't own it. Sell it and raise cash. How much cash? That depends on your situation. If you're young with a long time horizon, maybe 20%. If you're near retirement, maybe 40%. If you're already retired, maybe 50% or more. The point is to have dry powder when the opportunities come. I'm sitting on $334 billion. That's about 27% of Berkshire's total value. That's not because I'm scared. It's because I'm prepared. Second, focus on quality. The stocks you do hold should be wonderful businesses at fair prices, companies with strong balance sheets, low debt, high returns on capital, durable competitive advantages, and management teams you'd trust with your own money. Think Coca-Cola, not GameStop. Think American Express, Not Robinhood. Think Apple, though even Apple might get cheaper. Not whatever meme stock is trending on social media. These quality companies will fall in a crash. Everything falls, but they'll fall less and they'll recover faster. More importantly, they'll survive. That's the key. In a crash, survival is victory. Third, consider short-term treasuries. Right now, you can get 4% to 5% risk, free in T-bills. That's not exciting, but it's guaranteed. And when the crash comes and stocks are down 40%, that 4% you earned while waiting is going to look pretty smart. At Berkshire, we hold a lot of T-bills. They're boring, they're safe, and they let us sleep at night while we wait for opportunities. Fourth, prepare psychologically. This is the hardest part. When the crash comes, it's going to be terrifying. You're going to see your portfolio down 20%, then 30%, then 40%. Your neighbors are going to be panicking. The media is going to be breathless with doom. Your spouse might be questioning your sanity. You need to prepare yourself now for that environment. Write down your investment thesis for every stock you own. Write down why you believe in it, what would make you sell, and what would make you buy more. When the chaos hits, refer back to that document. It'll keep you grounded. Fifth, have a shopping list ready. Make a list right now of 10 to 20 stocks you'd love to own at the right price. Great businesses that are too expensive today. When the crash comes and they're 50% cheaper, you'll know exactly what to buy. Don't wait until the middle of the panic to start researching. Do your homework now. My current shopping list includes several excellent businesses I've been watching for years, but wouldn't touch at current valuations. When they're 40% cheaper, I'll back up the truck. Here's what most people don't understand about crashes. They're not just destructive, they're creative. They destroy overvaluation and create opportunity. They punish speculation and reward discipline. They separate the investors from the gamblers. In 2008 to 2009, when everyone was panicking, I invested $15.5 billion. I bought Goldman Sachs, General Electric, Swiss Re, Dow Chemical, and others. Those investments made Berkshire billions in profit. But more importantly, I bought when there was blood in the streets, when everyone else was selling, when fear was at a maximum. In 1974, when the market crashed 48%, I bought the Washington Post for $10 million. It was worth $400 million. That's the kind of opportunity that only appears and crashes. Ben Graham once said you should buy when others are fearful, but it's hard. It goes against every instinct. When everyone around you is panicking, your brain says panic too. You have to override that instinct with discipline and preparation. The coming crash will create similar opportunities. There will be wonderful businesses trading at 10 times earnings. There will be stocks yielding 6% or 7%. There will be assets selling for pennies on the dollar. But you'll only be able to take advantage if you have cash, if you have courage, and if you've done your homework in advance. I can't tell you the exact date. If I could, I'd be a fortune teller, not an investor, but I can tell you we're closer to the end than the beginning. All the conditions are in place. All the warning signs are flashing. It's like watching storm cloud. You know the rain is coming. You just don't know if it's in 5 minutes or 5 hours. My best guess, and it's only a guess, is that we see the beginning in the first half of 2026. Maybe it starts with a tech stock earnings miss in January or February. Maybe it starts with a geopolitical event in March or April. Maybe it starts with the Fed doing something unexpected. The trigger doesn't matter. What matters is that the conditions are ripe. The crash itself will probably play out over 12 to 18 months. That's how long it took in 2000 to 2002. That's how long it took in 2007 to 2009. It won't be a one-day event. It'll be a grinding, soul-crushing decline with occasional bear market rallies to give false hope before the next leg down. The bottom will probably come in late 2026 or early 2027. That's when you'll see true capitulation. When CNBC is running, is this the end of capitalism? Segments. When your barber and your dentist are telling you they've given up on stocks forever. When the cover of Time magazine shows a tombstone with the stock market, 1792 to 2026, written on it. That's when you buy with both hands. Now, after all this doom and gloom, let me tell you something important. I'm betting on a crash in the short term, but I'm betting on America in the long term. And I've never lost money betting on America. This country has been through civil wars, world wars, depressions, recessions, terrorist attacks, and pandemics. And every single time we've come back stronger. Why? Because America has the best economic system ever devised. We reward innovation. We protect property rights. We have the deepest capital markets. We have the best universities. We attract the best talent from around the world. A crash doesn't change any of that. It just resets the price of assets to more reasonable levels. It flushes out the speculation and the excess, and then the real work of building wealth can continue. So yes, sell your overvalued stocks. Yes, raise cash. Yes, prepare for a painful period. But don't give up on American business. Don't bet against innovation and human ingenuity. Don't let fear turn into paralysis. The S&P 500 in 1974 was at 68. It crashed to that level from 120. People thought it was the end. Today, it's at $6, and if you'd bought in 1974 and held, you'd be up 700%. Even if you bought at the 1973 high of 120, you'd still be up 900%. The same will be true of this crash. 10 years from now, the S&P will be higher than it is today. Maybe at $8,000 or $10 or $10,000. The people who buy during the crash will make fortunes. The people who panic will lose fortunes. Which one are you going to be? I'm 94 years old. I've lived through 16 recessions, multiple wars, stagflation in the 70s, the dot-com crash, the financial crisis, and COVID. I've seen every kind of market condition imaginable, and I can tell you with absolute certainty, this too shall pass. But the next year or two are going to test you. They're going to test your discipline, your courage, and your conviction. They're going to make you question everything you thought you knew about investing. That's by design. Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the rational, from the weak hands to the strong hands. I want you to be the strong hands. I want you to be the patient investor who buys when others are selling. I want you to be the rational thinker who sees opportunity where others see only fear. But to do that, you need to start preparing now. Not next month, not when the crash starts. Now, let me give you a concrete action plan. Week 1, review your portfolio. Write down every position you own and why you own it. Be brutally honest. If you bought something because it was going up, that's not a reason. If you can't explain the business model, that's a red flag. Week 2, start raising cash. Sell your weakest positions. Sell anything speculative. Sell anything you wouldn't buy today. Aim to raise 20% to 40% cash over the next few months. Week 3, create your shopping list. Identify 10 to 20 great businesses you'd love to own at the right price. Research them thoroughly. Know what they're worth. Know what price you'd be willing to pay. Week 4, fortify your personal finances. Build an emergency fund if you don't have one. Pay down high interest debt. Make sure you can survive 6 months with no income. The crash will affect more than just your portfolio. It might affect your job, your business, your home value. Be ready. Then once the crash starts, do nothing. Just watch and wait. Let the first dip pass. Let the second dip pass. Wait for true capitulation. You'll know it when you see it. Then and only then start deploying that cash you raised. Buy the wonderful businesses on your shopping list. Buy them slowly over weeks or months. Don't try to catch the exact bottom. Just buy when they're genuinely cheap. And then hold. Hold through the continued volatility. Hold through the bear market rallies. Hold through the doom and gloom. Hold until the sun comes out again, because it will. I've given you the warning. I've given you the roadmap. I've given you the action plan. What you do with this information is up to you. You can ignore it. You can stay fully invested in an overvalued market and hope you're one of the lucky ones who sells before the crash. Spoiler alert, you won't be. You can panic. You can sell everything right now and hide in cash for the next decade, missing all the opportunities that will emerge. Or you can be disciplined. You can prepare thoughtfully. You can position yourself to survive the crash and thrive on the other side. I know which one I'd choose. I've spent 75 years building Berkshire Hathaway from $7 a share to $700,000 a share by being disciplined, by being patient, by being prepared. The same principles that work for me will work for you, but you have to act. Knowledge without action is useless. Don't be the person who reads this, nods along, says, that makes sense, and then does nothing. Be the person who makes the hard decisions now so you can reap the rewards later. In 1949, Ben Graham published The Intelligent Investor. In Chapter 8, he introduced the concept of Mr. Market, an imaginary business partner who offers to buy your shares or sell you his shares every single day at different prices. Sometimes Mr. Market is optimistic and offers high prices. Sometimes he's pessimistic and offers low prices. The intelligent investor, Graham said, takes advantage of Mr. Market's mood swings rather than participating in them. Right now, in late 2025, Mr. Market is manic. He's euphoric. He's offering to sell you stocks at ridiculous prices because he's convinced they're going to the moon. The intelligent investor says, no thank you, and prepares for the day when Mr. Market is depressed and willing to sell wonderful businesses for pennies. That day is coming, probably in 2026. When it arrives, the prepared investor will make the investments of a lifetime. The unprepared investor will be wiped out. I've been Mr. Prepared my entire career. It's made me one of the wealthiest people on earth, not because I'm smarter than everyone else, but because I'm more disciplined. I wait for the right pitch. I don't swing at every ball. And when I do swing, I swing hard. The right pitch is coming. Are you going to be ready? That's all I've got for you today, folks. I hope I've given you something to think about. I hope I've convinced you to take action. And I hope when we look back on this period in a few years, you'll be able to say you were one of the smart ones who prepared. Remember, be fearful when others are greedy, and greedy when others are fearful. Right now, everyone's greedy. It's time to be fearful, but not paralyzed, not panicked, just prudent. Your financial future is in your hands. Make the right choices. Good luck out there.